Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Scott Hazlett, and Scott is a California attorney and CPA who practices in the areas of taxation, real estate, estate planning, financial problem resolution, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. In a past life, Scott was a sports writer covering Major League Baseball, National Football League, and other sports. Scott, thanks for joining me today.
Well, thanks for having me. I appreciate it.
Okay. Well, Scott, for a while, I don't think that people were doing many exchanges, when we had the sour downturn in 2008, but now it's 2016, so are people doing tax-deferred exchanges for real estate?
A lot has happened, certainly. In fact, my license plate is 1031 QI, so I get a lot of questions in the parking lot.
Okay.
And those people that know about exchanges and some don't, that kind of thing. But yes, the exchange business has roared back to life as much, or if not more, than before the fall of 2008 when we had the big crash.
Right.
So we certainly have a lot of activities, and the numbers just seem to get bigger and bigger every day. It's pretty amazing.
Okay. So Section 1031 is one Internal Revenue Code section that everybody seems to know.
Yes.
And so basically what we're talking about, again, is tax-deferred exchanges. Some people call them tax-free exchanges, but we accountants and attorneys call them tax-deferred because we know sooner or later probably the piper's going to have to be paid. What is a 1031 exchange? Maybe you can explain.
So the simplest or the most common type of transaction, a way to explain this is, if you have a piece of investment real estate, and our practice focuses on real estate, although you could do a 1031 exchange on equipment and those types of things, but we tend to focus on real estate.
Right.
So you have business or investment real estate, and if you sell the real estate, you pay a tax, and the tax is based on the sale price minus the selling expenses such as commissions, minus what accountants call basis, which is typically your purchase price, with some adjustments for depreciation you might have taken in prior years. So there's this gain. And when there's a gain, the IRS wants you to claim it as income, essentially, on which tax will be assessed for your income taxes.
Uh-huh.
So in the alternative to that, there's a concept that's been around for now nearly 100 years in the tax code, predecessor to 1031, where if you relinquish real business or investment realty, and you acquire replacement like-kind realty or property, as the case may be, then the gain is not recognized immediately, but it's deferred into the future, and so you don't have to pay.
Mm-hmm.
So as a result, there's a great deal of motivation by someone who wants to divest of property A and acquire property B. There's a great deal of motivation to meet all the guidelines so that they can do that transition without having to pay an income tax.
Okay. Now, for real estate, what is considered to be like kind?
It's extremely broad. So an investor might currently own a single-family home that's rented out. And we're not talking about your principal home, and vacation homes we might talk about a little bit later, but we're talking about something that's conventionally, strictly an investment property by virtue of renting it out. That person can sell the single-family home rental and buy multifamily, can buy another single family, could buy commercial, could buy industrial, retail, land. Pretty much if it's real estate and it's investment or business, it's considered like kind.
Okay. So I think one thing, again, so especially when we talk about vacation homes and things, I think it's a little critical for us to, again, remind people that we're not talking about an exchange for like a business piece of property for a residential property that you're going to live in or something like
Correct.
that, or even the other way around. So
Correct.
quite often people say, oh, I don't want to deal with the...
Correct. Yeah, there's a number of things. I mean, one myth that seems to be floating around out there sometimes is somebody will say, "Can I sell my investment duplex, take the proceeds, and pay off a loan against another property?" That's not considered an exchange. You actually have to buy another property.
Right.
Okay. Another myth is, well, I want to sell my investment duplex, and I read somewhere that if I buy a house on the beach in Carmel, that can somehow be an investment because it said it on the internet, which the internet's always true, which is obviously a myth also.
Okay.
And the point being that you have to be very, very careful, and you have to get qualified advice on what constitutes this investment concept.
Right.
And there's much written and so forth and so on. It's very, very complicated.
Okay. Let's say that I do set up one of these exchanges. Could I have taxable income from that?
It's possible, and sometimes it's actually desirable the way it's set, the way the tax rules are set up. So the other day I had a conversation with a guy, and he was talking about a property. This is an aside. He was talking about a fourplex where he actually had lived in one of the units.
Uh-huh.
And he told me that he was thinking about using, he hired us to be the intermediary, but he was thinking about using a guy who said he invented exchanges, which would make that guy about 105 years old, of course.
Okay.
And as I told the guy, I deal in the whole tax code. So in this case, he had a home sale, which is a different code section for a different program that will air later, 121. And then he had this other section, which was the investment piece, which is for 1031s. Now, so the way things set up, actually, he got cash in his pocket because he's got some special exclusions. I don't need to go into all that. There's another example where if let's say I own a property that's worth 100 and I sell it, and it's net of commission, and let's just assume there's no loans to keep it real simple. And let's say I go out there and buy a replacement property for 80, okay? If I do that, what I've received in return is 20 in cash and 80 in like-kind real estate.
Right.
Well, the 20 in cash is taxable. It's called boot. But that might be okay because maybe there's a zero tax bracket on that portion. Maybe there's other losses offsetting that and so forth and so on. This is why an exchange is more than just calling up saying, do my exchange. It really is call the accountant and say, if I sell this property without an exchange, what happens to me? And then view the variety of permutations on the arrangement to get the optimal outcome.
Uh-huh. So, and one thing is that you skated around again is this business of the liabilities, and actually the liabilities sometimes, if they don't match up right, you could have boot
there's
related
a problem.
to that.
Yeah, so I'll give you an example, real perfect example, and some taxpayers out there and some real estate agents mix the metaphors and so forth and so on. So let's say you had a property for, you were selling for 100 net of the selling expenses, and you're paying off a loan of 40, and so you have 60 equity on net proceeds. So some people say, well, I'll do an exchange, I'll take the 60 and just buy a piece of property for 60, and I'll therefore reinvest all my proceeds. Well, the problem is you've got debt relief, and the income tax code views that as being income.
It's cash, basically.
It's cash, basically, even though you don't get the money.
Yeah.
So the refrain from the taxpayer who sees the accountant next year, who hadn't thought this all the way through, how could I have taxable income? I didn't get any money.
Right.
Well, you got the benefit of the money by the loan payoff. So that's another thing to watch out for. That's easily remedied by buying another property for 100 or more and getting a new loan to replace the old loan. It's as simple as that, really.
It is as simple as that, but the problem is that people don't think it through, and they're just thinking cash.
Correct.
Or cash in hand, maybe I should
Right.
say. And the problem is that the hand may be your lender's hand.
Right,
So
right. And they're also thinking that the tax advice from the real estate agent is cheaper than the tax advice from the CPA.
And that may be. And,
Yeah.
and some CPAs are probably sharper on this than others.
Right.
Okay, so what's a deferred exchange and what is a simultaneous exchange, and is there any significance there anymore?
As a practical matter, no, there's no significance, but historically, exchanges actually were sort of in the backwater until about the late 60s, early 70s. And exchanges came about because farmers would trade land with each other. I have black acre, you have green acre. We agree that they're the same value. We trade for whatever reason we're trading. And public policy said, shouldn't penalize these guys and tax them on this trade So let them be sort of tax deferred into the future. So then somebody came along, and the other common thing today is you have a business vehicle, a truck, and you trade it in at the dealer.
Yeah.
That's a 1031 exchange. That's a simultaneous exchange. So you avoid the gain on the old property and get into the new property. For real estate, though, in general, this non-simultaneous exchange, is sometimes called a deferred exchange, is a situation where you have an independent sale that, for all practical purposes, has nothing to do with the purchase of the replacement property. And the only way they're strung together is this legal fiction of the so-called qualified intermediary. So there's two things that happen there. One is I sell my property and I take the money. I have a taxable event. I sell my money and I don't take the money, but I've voluntarily sort of tied myself to this intermediary who takes the money in trust and holds it,
Right.
and then uses it for down payment for the replacement property. That is technically, for tax purposes, an exchange, even though really it's a sale followed by a purchase. But all the little minutiae and the details and the paperwork, they have to be in place to avoid the problem of the taxable gain on the sale.
Right. So you have to, there's paperwork, like you said, that sort of ties the whole thing together. And
Correct.
so if you don't have that paperwork in place, then you're not going to have an exchange.
Correct.
It's not something you can do after, set up after you've made your sale.
Right, and I've actually, that brings up a good point where somebody will close a sale, and then they'll call me up or somebody like me, and they'll say, "Well, I'm ready to do my exchange now."
That's
and
nice.
I say, "Yeah, well, you're ready, but you're not able because it's too late. You have to set all this up pre-closing."
Right. What's a reverse exchange?
That's an interesting concept that was very controversial for a long time ago, and then about 15 years ago, the IRS actually provided a safe harbor. It's a really great situation. So a reverse exchange is a situation where you can actually buy the replacement property before selling the relinquished property. Now, all the numerical things that we've been talking about, those balancing, that all applies, but this enables a taxpayer to go out and actually nail down that piece of replacement property that's very ideal, say in a very desirable market, or property that's here today, gone tomorrow, and they have to sell it, and they really want to get rid of something, but they're just not ready yet. They have a tenant, they need to repair it, they need all this kind of thing. So they buy this, and it's said to be parked. They don't really buy it, they park it. They hire me to hold it for them. And then when they're ready to sell this one over here later, they sell it to somebody else, and then I give them this replacement property that's been parked through the
Qualified intermediary.
Through the intermediary, correct?
Right. Okay. What are the requirements for identifying a replacement property?
So here's a very interesting situation. So this is a law that came into effect under the 1031 moniker in 1984, and it used to be that you would have these reverse exchanges, and they were under a court case called the Starker case. It didn't have any of these time horizons. So in '84, the Congress codified the requirement of identifying replacement properties and then a time frame for buying. So let's say today is the 19th of May, right? 19th,
Yeah,
okay.
yeah.
So 19th of May, 45 days from today is 30 days in April, 11 days left in this month.
There's actually
June.
June.
4th. June 4th. So if you close escrow today on the sale of your investment duplex, you have to identify your replacement property on or before June 4th.
I think it's July 4th, actually. So.
That's June. Oh, you're right, July.
Okay.
I was thinking April.
Yeah.
July 4th.
We're CPAs, we get stuck in.
Yeah. I used to be able to do this. I'm old now, so here's another, just a sidelight on July 4th. It's not July 5th because July 4th is a holiday. It's
Right.
July 4th or prior.
Uh-huh.
Identifying is most customarily a letter postmarked on or before the deadline, can be received after, addressed to the intermediary, containing a simple form that says, "I hereby identify property 1, property 2, property 3, whatever the case may be, in conjunction with this exchange or this sale that occurred on May 19th. So the 45 days is the most critical timing, and all too often I'll close an exchange. They'll call me today and they'll say, "We're closing tomorrow," and we rush the paper, we get it all done, we work it out. And then my question is, "Well, what were you thinking about for a replacement property?" "I don't know yet, we haven't decided." "Well, buddy, you better get it in gear,
Uh-huh.
because this clock goes faster in the 45 days.
Yes.
You got to get it in gear.
Yes.
And all too often we see somebody making a lateral move or buying some property under pressure. It's just very sad. So the walk away is try to line those things up even before you sell.
Yeah. So I had an investor client years ago, did quite a few exchanges, and he said, I always try to know what the replacement is before I make the sale.
Correct. And along those lines, when I talk to people, should I exchange? I think it's like so many other things in life. You should want to know where you're going before you leave where you are. Mm-hmm. Where you are might not be that great, but at least you know all about it. Because you might be going to a really bad place over there.
Okay.
So.
Now, what about when this whole thing has to be done? When the replacement property has to be acquired?
So that same 84 Act gave us 180 days to close, and the 45 days and the 180 days run at the same time. So May 19th, I'll just wing it. Here's November 16th, 15th. It's not 6 months. It's 180 days, so you take a few days off. So I think it's like November 15th if you did the math.
Uh-huh. And another thing to bear in mind is that when these things happen at the end of the year, then it's the earlier of the filing date for the tax return or the 180 days. So typically everybody has to do an extension.
Yeah, correct. So that rule applies for exchanges where the relinquished property is sold on or after October 16th, I believe it is, 15th or 16th, call it. And in order the law provides that if you file your tax return, which would be April 15th for individuals, that ends the 180 days, can cut short. So you get the extension and get the full time frame.
All right. So what is the role of the qualified intermediary?
The qualified intermediary is the place basically where the money is parked. So here's the philosophy. So it's possible for you as an investor to go out, sell your property, get the money with good intention to take that money and go buy something else and meet all the other mathematical and qualitative requirements of exchange. However, the tax rules view the receipt of that money as a closed taxable event. So the regulations were created in 91 that provided for this legal fiction of this, what amounts to an agent, a hired gun, if you will, holding your money. So there's a sale, and then there's an exchange agreement, which is again codified in these regulations. And the role of the exchange agreement and the qualified intermediary is to keep the money segregated from the dominion or control of the taxpayer. And how we do it, for example, is we will, if you would exchange with us, we'll have all the instructions in escrow such that the money is wired to a bank and earmarked for a segregated account, which has your name and my name on it together. And it's clearly marked as being reserved only for the purchase of qualifying replacement property.
Okay. Is there any risk when you choose an intermediary?
Absolutely. It's probably better than it was, but there have been cases where, and still to this day, in many states, the 1031 business is unregulated. So you can hire anybody can set up a corporation, you don't have to be a lawyer or CPA or anything. And so you close a deal, the money goes to that place, and then you call them up the next day and you find out their number's disconnected and they've gone somewhere else. They've taken your money. So interestingly, it doesn't just happen to little places. It can happen to big places. There was an event in 2007 that really scared a lot of people. Land America was a title company that went bankrupt, and a lot of their exchange funds were sort of commingled in their general. They were an insurance company, so you think, oh, it's safe, it's an insurance company. So the funds were commingled, and they went bankrupt. And the funds and exchanging taxpayers lost a lot of the money.
Yeah.
So in response to that, in California, we have a couple of rules. One is you might hear of intermediaries having bonds. That's not really practical because you find out that the bond amount that they have is far deficient, shall we say, for all the funds. So I'm holding, as intermediary at any point in time, I'm holding well into 8 figures, 9 figures of cash, depending on what kind of volume we have. And so if I have $1 million bond, it's not really very meaningful. Now, an alternative approach is to have the funds put into a bank in a segregated account where the account or the bank has agreed on their end, they will not release money unless they see a signature of both myself and the taxpayer on the same piece of paper, designated the money to go somewhere, and it's typically a title company or an escrow company that's readily verifiable. So that's the safety. That we've done that long before that law was put into place, but that's the safety net at this point.
Okay. So I actually had a situation with a client who used a bank as an intermediary, and the bank said somehow this money disappeared.
Unbelievable.
Unbelievable.
Yeah.
So, so this isn't a problem-free stuff, folks, unfortunately.
Yes.
And it's important to deal with with very reliable people. And again, some of these organizations that we've seen that have failed, have been very large, and so
Right.
so it
And
makes
then
it
there's
a little
some
frightening.
crooks. There's some outright crooks. There's some people
Yeah.
that just took the money and they were crooked. So it just depends.
Yeah. Okay. Well, maybe I should put it this way. What if the intermediary defaults? Okay, what if you don't get the money?
Well, that's along the lines of Land America and so forth. So,
Yeah.
that did happen in 2008. So the IRS put out a ruling. I think it's 2010-13. Is my memory serve correct?
I'm not sure.
Okay. So there is a revenue procedure. It's about 8 or 10 pages, and it describes a situation in which the taxpayer doesn't get the money back, essentially. You only have 180 days. There's no extension of that time frame. Let's say I have the money and for some reason it got invested somehow and it's illiquid and it won't be until day 181, but I'll give you your money back. Well, that does the taxpayer no good, essentially. But if you do default, effectively it becomes like an installment sale.
Right.
And so you have to just consult with your tax preparer to help you out. And it's basically maybe money you're going to receive down the road. I know I did a couple of these Land America clients, and they had $800,000 each with the company, and I think at the end they got a couple hundred back. So their taxable gain, which they had, there was no exchange for that piece. The taxable gain was measured on the money they actually got back.
Uh-huh.
So.
Uh-huh. Okay. Can the intermediary provide tax advice?
Well, the intermediary is supposed to be independent of the taxpayer. There's a thing in the regulations called disqualified intermediary. So a disqualified intermediary is someone who has been the accountant, the attorney, the broker, the banker, and a number of other people sort of in the inner circle of any person who's financially sophisticated. So the intermediary is got to be independent of that relationship. Well, as a result, now it's quite common for lawyers and CPAs to have intermediary companies because it makes a lot of sense. In our case, in fact, the way our intermediary is set up, the intermediary company is independent of my law practice, my CPA practice. But necessarily by the rules of practicing law and accounting and all that kind of stuff, and also by these 1031 rules, the intermediary tends to give information but really can't provide counsel because it's supposed to be independent of the taxpayer.
Right. Can you use the proceeds from the sale of a property to build a replacement property in an exchange?
Yes, there's a concept called an improvement exchange. So a typical scenario will be we close on the sale of the relinquished property today. Very soon we buy the replacement property, and much like a reverse exchange, the replacement property, say it's a piece of raw land, is parked with the exchange company, it's called the Exchange Accommodation Title Holder, or EAT. So the EAT holds the land, and then over the next 180 days through the exchange period, the taxpayer becomes basically the project manager or coordinator for getting the construction crew out there and doing the improvements and so forth. At the end of the 180 days, this exchange company hands the property back to the taxpayer as is, finished or not finished. And the good news is that all the money that's been spent to that point is included in that exchange mathematics, that balancing. So it is possible, in fact, to do that. However, having said that, if you sell one, buy one, and close both through an exchange, and you own it, and there's no parking arrangement, any improvements after that do not count towards your exchange. So I always tell people, in short, there's a right way and there's a wrong way. You should do the right thing.
Okay. So we have just a very brief time left, but I would like you to mention California reporting requirements for non-residents and out-of-state real estate.
So beginning for exchanges that started in 2014, I'll just run through a real quick example. So Joe lives in San Jose. He's an investor, and he has say a sixplex apartment and a house in San Jose. And then Mike's his accountant, and he goes to Mike and he says, Mike, I am so sick of Jerry Brown or whoever's in office. I don't want to pay taxes anymore. I hate taxes. I hate taxes. I'm going to Reno, Nevada to live, and I'm taking my real estate with me. Okay, that's fine. So federal law allows for a 1031 exchange, and California law allows for a 1031 exchange. So Joe goes and buys a main home or rents something to live in Reno. He sells a sixplex in San Jose. He does a 1031 exchange into a sixplex in Reno, Nevada, and he's completely separate from California. In that fact pattern, there still is a deferred gain. California recognizes the deferral from the San Jose sixplex, and that's now sort of embedded in this Reno property. At the time that Joe sells the Reno property, whether it's next year or 10 years from now or 20 years from now, this gain that's been transferred, and just that portion, that triggers. So in 2014, the Franchise Tax Board said, hey, we need to keep track of guys like Joe because too many guys have left and taken their real estate, and we don't know about the gain. So now Joe has to file a form with Jerry Brown every year to tell him, hey, I haven't sold the property.
Okay, that's all that we have time for. So folks, hope we've given you some things to think about. Again, we want you to get advice related to this. This is just the beginning of a conversation you should have with your tax advisor. I've got a book you might think about. It's a Real Estate Tax Handbook. You can get it at Amazon.com. I have a chapter on there on tax deferred exchanges. Scott took a look at it. So we'll see you next time on Financial Insider Weekly.